You can't replace part of the brain. Like,
you treat them the same.
Source of truth for the MedTech industry.
Coexists with the puppets.
Robot understands things automatically.
Number one show in the MedTech industry.
So Stryker got ahead of that and changed in the $90 billion company. They had help up high, a lot of things.
State of MedTech with your host, Omar and Khateeb.
Hey everybody, welcome back to the show. This is an episode that has been in the making for a few years now. I'm joined by a good friend of mine, somebody who I have a tremendous amount of respect for, is Bruce Cleveland, who I'll allow him to, in a second, to give an intro on his background. But for many of you, you know that a big staple of my career and work has always been the technology adoption curve, which was Geoffrey Moore's work, right? And so after that came out, I always felt like something was missing. Right. And like every great movie, there has to be kind of like an extension of it. Most of the time, the sequels suck. But this one was even better because it kind of took a lot of the foundation of that work in the technology adoption curve and extended it in such an impactful way that I think every single startup founder needs to understand in order to raise money at the right inflection points. So many of you have seen me reference it. You've seen me do reviews on it, which is Traversing the Traction Gap. Bruce is the author of this amazing book, and he's going to talk to us a little bit more about the foundations of what does it mean to essentially get the traction you need at certain inflection points of a company's life cycle and beyond. So Bruce, thank you so much for joining the show. How are you doing today?
You bet. Thanks a lot, Omar. I'm doing great.
Absolutely. So Bruce, maybe for the audience who is just learning about you now, can you give a little bit of a background on yourself and your career before we kind of dive in?
Yeah, I'd be happy to. So I spent several decades as an operating executive. I'm also a founder of a company that's actually doing quite well right now. I found a great CEO to take it over for me, and I was also in venture capital for a couple decades as well. So I've got a pretty well-rounded experience, mostly out of Silicon Valley, in running engineering, product management, product marketing, corporate marketing. Most of the functions, either as the president of a division or running a division, I've run most of these different functions in technology companies. Oracle was a small startup, a private company when I joined it. Went on to run an engineering division at Apple. I ran a number of different functions for a company called Siebel Systems, which is the company that created the CRM category. Sold the company to Oracle, and then Salesforce, of course, has done quite well with it. I'm not sure that Oracle did what needed to be done, but that's the way it goes with those acquisitions. Went into venture capital. Most of the things that I invested in were just concepts. They really weren't companies yet, which I think is the true definition of venture. Finding a couple of entrepreneurs, come up with an idea, kick it around, and some of those ideas actually have become multi-billion-dollar companies. One of them is called Marketo, was acquired by Adobe. Another called Doximity, which was, think LinkedIn for physicians. That was just an idea. I didn't create these companies. I've just found great entrepreneurs to do them. And I did kick around a lot of ideas with them, but I didn't run them. But I did run my own. I created a company that I call Greenfig. It's now called Ziplines Education. It teaches either lane changers, that's people already in the profession, or students, how to apply digital technology, Salesforce, HubSpot, Tableau, et cetera. How do you apply those technologies? Not the mechanics of the tools. Those companies have great training programs, but the strategy of how to use them. What is the customer journey? What should the demand gen campaign look like? Those types of things, and that's now a multi-tens of $million profitable company. That was just an idea in the back of my head, mostly to solve a problem that I had, which was I couldn't find people who knew how to operate those applications, the tools of the 21st century. So ending up my formal, sort of more corporate career, I was asked to come help take a company called C3 AI, which is now an NYSE public company, help it go public. And so I joined my former boss, Tom Siebold, as his CMO. We created a new category called Enterprise AI. Subsequently took the company public, and they're doing quite well. I stayed there for a few years, and then told Tom that that was the end of my operating career from that standpoint. And I left to go do some other things. And those other things, one of them was during the process of just after my decision to leave venture, I wrote a book called Traversing the Traction Gap, which effectively discusses what I learned as a venture capitalist, which is not necessarily well disclosed by the venture community. I wanted to be able to help people better understand the mechanics of not only raising money, but also how do they invest that money? How do they manage it across the different functional phases of companies, from the time you have an idea, call it ideation, through the go to product phase. Then finally we have this thing called a minimum viable product, and then we have a go to market phase, and then all that stuff starts working and we have a go to scale phase. So I wrote a book about this. It's a prescriptive guide to help both entrepreneurs and investors better understand what's needed at what moment in time, because different things are required at different points in the maturity cycle of a company. So I felt that the venture community wasn't forthright, or maybe it doesn't mean to not be forthright, but there was no taxonomy. There was really no guideposts to sort of, as an entrepreneur, how do you raise this capital? What is the venture community looking for? And then if you are able to raise it, how do you make your company successful in the amount of time that you're going to be given? And that's one of the major elements of this traction gap framework that I created, is time. And so what do you need to do? What do you need to get accomplished within what period of time and in what phase of the company? Because I thought by doing this and then actually showing people how to do it and what to do, it would be helpful. And so we released that book, and it's done, it's done fairly well. I was able to teach a lot of it at Stanford from time to time, Columbia, Harvard, some schools that have some value. And so I enjoy doing that. But more importantly, I think it's helped the entrepreneurial community, and hopefully the venture community as well, because if we can make their startups work, they can get more capital to put back to work into the startup community. So that's kind of what I've been doing. I quote retired from C3 a few years ago, and I created an advisory firm. Well, actually what I did is create an idea for an advisory firm built around the concepts in the book. So I wanted to see if they would work. So I took on some clients at basically at very low cost, and I wanted to see if we could apply this process, and it's worked quite well. So this past few months, I've launched an advisory firm around market engineering, and that's really what the soul of the book is about, which is you can have a great product. In fact, that's table stakes, is to have a great product engineering. But the thing I have found that differentiates the winners from the rest is almost always great market engineering. And what I mean by that, it's a term I coined in the book to stand for things like thought leadership, category definition or redefinition, storytelling, messaging, positioning. These things become critically important because you're dealing with a cacophony of voices out there, and you need to be able to clearly differentiate who you are, what you do, why you do it, and you don't want to compete in an existing category if you can possibly help it, because somebody else there is the category leader and they define the terms of competition. So that's what I've been working on. And then along the side, I've been racing with Ferrari for a couple of years, and I took first in the U.S. in my class this year.
Congratulations! I saw that, and you had a pretty scary crash that I saw on Facebook earlier in the year. But I'm glad you kind of recovered from that and came back and won. It was a great sort of following along for the year.
Yeah, well, I had two like that. If I wouldn't have taken, I would have, could have, should have, right? I mean, that's kind of the deal about racing, is that you can say anything you want, but it all ends with, did you do it or did you not do it? Did you win or did you not win? I kind of like that, and I kind of hate it because there's just no room for excuses. So yeah, I got hit by a guy who did sort of a stupid move. A couple of them. I did one stupid move that took me out and a friend of mine out, but it was pouring rain, and so I give myself some forgiveness. But those two things were at Sonoma Raceway and at Indy were big things. One broke my ribs, and so I had to deal with that. So yeah, so it's been a really interesting process. I raced with some really cool people. Most of them don't come from the tech industry. But most of them are self-made. One built a plywood business from scratch. Another built a real estate development company, one of the largest in Texas. Another went to Harvard Business School and built a trucking company, now with thousands of employees. So, I mean, they're really cool people, and they have really great stories to tell you, but nothing really. There's a couple of people in tech, but, for the most part, they come from, lots of different places. I think the single thread that I enjoy the most is that they appreciate entrepreneurship. So, and a lot of fun.
So, going back on, to the traction gap, where do you feel most companies get off to the wrong start?
Yeah. Well, I don't know if it's the wrong start at first, but it is definitely the wrong start when they take in their first venture money for the most part.
Can we define that as a time period? Like, would this be like your pre-seed round, seed? Like when is it? Because I feel like at some point, sometimes when you raise money, that's when a lot of bad things happen because people get relaxed and then they're not being as disciplined. When do you feel like that would be? I know it's kind of a broad question, but I'm wondering if you had a rule of thumb of where that usually happens, where things start to go awry.
Let me use it. I'll answer your question, but let me use kind of a metaphor that I've created. I think it helps to set the context of what we're talking about. I said that one of the 5 tenets of market engineering is category design or redesign. For me, that the category is similar to a stadium in sports. It's a place where we're going to play the game. We have to have a place to play the game. And the stadium has to be built. It's got to have a foundation. It's got to have bleachers. It's got to have all those things. And then it's going to host a game. And the game has rules. So we can play different games in the category. They could be that would be tantamount to subcategories. But the category is the place where we're going to go play the game. The teams are the brands, are the companies, and you have to create teams that want to play the game. This is one of the interesting facts, is that you can't create a category of one. You have to actually, if you create the category, you then have to compel others to participate in the category with you. It's a little ironic. It forces you to stay one step ahead of everybody, but we can't have a game. We can't have competition. No one's going to come to the game. Those would be your prospects and customers. No one's going to come to the stadium to watch the game that's played unless they know about the game, what the rules are, and the various teams that play. So I think the metaphor works. It may be stretched in a few areas. But now I'm going to circle back to address your question. The mistake that most people make is that they build a team. They build a company. And I don't mean the players. I don't mean the people. They build the company. That would be the product. And they don't think about they don't think about the stadium building. And so what happens then is they build the team, the product, and then they start trying to sell tickets. The tickets would be demand gen. Tickets would be, okay, we're going to have a game on Saturday, and people look and go, I don't know, what's that game? Where are you guys playing the game? Who's playing against whom? We don't know anything about it. We're not coming. So that, again, may be a stretched metaphor, but I like to look at it this way, that we need to, the bad things that happen for most companies is, one, they don't start out with category definition, creation, building thought leadership for their position. That is where the stadium is, where the category is played, what the rules, the attributes of the category are. They spend very little time up front doing that. They get some venture capital. Maybe they get $500,000, or maybe they get $5 million or more. It doesn't matter. They get capital. And the first thing that typically happens is, when are you going to take your product to market? Where's your demand gen happening? How many leads do you have? Who's running sales? All that stuff. And the mistake is, that's when you start lighting Benjamins, a lot of them. And the fact is, you haven't built the stadium yet. You haven't built the category yet. You need to build the category before you start doing the demand gen. You need to build thought leadership, invest in that for 12 to 18 months, keep the burn down extraordinarily low. Doesn't mean you're not selling at all. It means the management team goes and sells. They sell the first 10 customers. One, you want that anyway, because the management team should know what it takes to go from contact to cash. They should understand, what did I have to do? What did I have to demonstrate to convince somebody to write a check to pay us for our product and services? If the management team doesn't know that, if the CEO, the founders don't know that, how do you hire a salesperson to then go just make it up? So they try all different sorts of things, and so you'll find that a lot of cash is burnt. A lot of the most expensive capital, which is your very first 1 or 2 rounds, it is being spent by delegating that process to somebody who is running an experiment. The experiment should be run while you're doing thought leadership. The experiment with selling should be done by the management team, the head of engineering, the head of marketing, the head of sales, the CEO. The management team should sell, and then get together and learn what did it take, and then harden that before we ever start thinking about really bringing on putting the supercharger onto the engine, because otherwise you're just going to dump a bunch of fuel into a suboptimal engine. It could be a 4-banger that couldn't even ingest all that fuel, and you get nothing out of it. So the net of it is that's where I see a lot of companies, a lot of startups making mistakes, is because the venture team comes in and goes, okay, you said we were going to get X amount of revenue or whatever it was going to be. Well, let's get going. Where's the team that's going to do this? Where how many leads? All that stuff, and that's a huge mistake. We need to first focus companies on category definition, category building. We need not just proxies. We can actually set up systems that tell us how well our category is doing. How many times was the category name mentioned? How many industry analysts used it? How many publications used it? How many times did it get picked up in a conference? How many white papers were read with it? How many searches were done for that term? How many times was my company associated with that search term? We can measure this. In fact, I did this for C3AI when I joined as the CMO.
With enterprise AI?
It didn't exist.
Yeah, and I want to point that out to people, because a lot of people have heard and know about enterprise AI, where you're literally talking to the guy who essentially manufactured that term.
It was the thing is, and this is what you have to get comfortable with, is you actually it's okay if other people are using a term, but you're going to have to conscript it then for yourself. You're going to have to redefine it in your. But in this case, I think it was only one digital magazine that was using the term enterprise AI. Nobody else really was. So we were able to write a simple Google report. I mean, I ended up doing it in Microsoft Power Builder at one point, but you could use SEMrush. I mean, you can use whatever tools you want. Doesn't matter. But you can actually look weekly to see how are you doing. And there's a reason you want to do well here, because in the digital, when we get ready to do branding, brand demand generation, we want to make sure that Google has scored our website so that we rank high. If we don't rank high, the cost for advertising, CPC and CPMs, is a lot higher. So you can get a dramatic lowering of your AdWord cost spend if you can increase the ranking of your website, which is totally reliant upon the content that you're producing and having people go there. And we can talk about some hacks for that. But right.
Yeah, and I want to share this to the people who are watching on YouTube and Spotify. But I remember when Enterprise AI came out, and this is when you and I were just getting acquainted, and then I realized, I'm like, oh, like that's not just some random term that was thrown out there. That was actually intentionally created, and my new friend, this guy I met, Bruce, is like the reason why it's out there. And I remember when I searched for it, so like you guys can go online and find it, but when you look up what is enterprise AI, like C3AI's page comes up, and then there's this white paper, which is a 22-page long paper. I remember reading it, that essentially frames the problem, and it's kind of like a manifesto for it. But I think the most important thing that I learned from this is that with the prospects in the market, and if you think about technology adoption, there's that small slither of early, not even early adopters, innovators, where you're teaching them, this is the old problem. Here's a new term for this old problem. Here's a new way of solving everything. And essentially you're developing the language that's going to allow people to adopt a new product, which is adjacent to this whole category design approach. Is that correct?
Yeah, I am. I give full credit for the term enterprise AI to Tom Siebel. I ended up doing all the crafting of getting it out there. But Tom is the one that asked me, because Tom is a master category builder. I didn't have to teach him why that was important, which is which is helpful when your CEO understands why this stuff matters. You don't have to do a lot of hand waving. So I remember the prior to coming I worked for Tom for many years at Siebel Systems, but prior to joining C3AI, I remember Tom saying, look, I need you to go build me a category. We need it. It's called Enterprise AI. Do whatever it takes to do that. So we did whatever it took to do it, which was a lot of different things. But to your point, we defined the term, and we assigned the attributes of it, and then we used these hacks that you just showed, which was the white paper, to help position that. And we did another hack as well. If you go to that same website and you go to the resources tab, which is at the top of the homepage, under there is something called Glossary. And if you look at Glossary, in it there's 3 sections to each term. So it's a glossary of terms related to machine learning and AI. Everywhere, things like Bayesian, random, forest. I mean, just a lot of different terms that are associated with what we all know to be AI. The first part is, what is the term? What is the name? What is the term itself? What does it mean? The definition of the term. Then the second section is, why is it important? And the third is, what does C3 do with that? How do we help with that? Not everything is something that we help with, but wherever there were things that we did. And then at the bottom are a list of other publications in our website that provide more insight. Why did we do that? Well, because Google parses, they crawl all the websites, and they parse this, and they determine whether are you selling something or are you educating someone. Well, this is all educational. It's not selling our product. So there's 2 things that affects. They stay on your site longer, so that reduces your bounce rate. If you come from one website into your website, you want people to stay there longer. Google gives you higher credit, your website goes up in score, your CPM and CPC rates go down. The next part to that is you want them to stay inside your domain. So you have to have other publications, other things for them to review that aren't salesy things. They're more educational things. So that's what we put down at the bottom of the page, our thumbnails that are links to other sections of the website. That process took us from being nothing. I mean, we scored nowhere in the web rankings to where we were up in the very top. At one point, until other people got wise to how this enterprise AI thing, we owned the snippet for Google. And so for those of you who don't know what that is, it means on the first page, if you typed in enterprise AI, a set of content would display by Google. You don't pay for it, as the company doesn't pay for it, displays that company's content. And so you want to win that snippet. And so what I just explained was a hack to win that. But this is all part of that market engineering work that I do with my clients, where we create, first we define what the category that we want to create. We create something called a messaging matrix, which is effectively a long document that explains who we are, what we do, why we do it, the category. We design it, and then we explain competitors and a bunch of other things that go into this. And this becomes your universal source of truth for all communication, whether it's internal in the company to employees, when they're joining the company, whether it's on your website, white papers, books, conferences. This is the gold standard for everything that you communicate. Companies fail to do this as well. I mean, if you've ever listened to an SDR team, where the company doesn't have this strong sense of category and the language. You said language, very important. My friend who wrote Play Bigger, Christopher Lochhead, and his buddies call it languaging. You need your own you need to have interesting, compelling language, vernacular that forces people to, what Steve Jobs once said, think different. So we want to force people to think different, because that makes them engage and actively put neurons into the process. Otherwise, this stuff goes into one ear and out the other. It's just word salad. There's no comprehension there. So we want to use special language. We use this messaging matrix to create the language, and then we flow all of that into your sales deck, investor deck, conference deck. A conference deck is an educational deck. You're not really selling your company. You're selling concepts, where you're speaking as a keynote speaker or a panelist. We flow it into our white papers. We use it to brief the press. We use it to brief industry analysts. We have to have this, and we have to have everybody in the company using the same language, the same provocative language, because if you don't, you go to that SDR team and you can listen to several different people, and you can listen to how they explain what their company is and what it does. And, I've found, for the most part, when it's not done right, everybody comes up with their own positioning of the company. And that is not the way to build a brand or a category.
I couldn't have said it better myself. And, the thing that really stuck out to me is, and I think this happens so often in the MedTech world where, they go through this period pre-FDA, right, where you don't really have a sales team. You might have like one sales leader, but you have time, right? But they don't spend the time really nurturing and developing the market. And then the moment they get FDA clearance, they hire a sales team to hit the street, assuming that there's a market to sell to, right? And I think I love following you on LinkedIn, and even more so, I think you're one of my trolling is like an art form. I don't think you definitely don't troll, but your comments are probably by themselves like they should be their own posts. But you once commented a while back about this concept of like product market fit versus market product fit. Can you kind of expand a little bit on that?
Yeah, it's funny because I just saw somebody else post something like they invented this. Maybe they did, but I wrote about it in 2015, 2014. Probably somebody did it before me. But
I read a lot. I never heard that until I met you. So
yeah. So it doesn't really matter who invented it. I do think it matters. So without a market, there's no need for your product, and that was the problem I had with product market fit. It put the product first and put the market second, and that is you need to invert that. You need to build the market. There was nobody asking for a minivan. This is before the internet was widely used. Nobody was entering the word minivan in. They had to create it. What happened? Iacocca and Chrysler had realized that people like station wagons, sort of, but they sucked in other ways. And so vans seemed to be able to carry things, but they were terrible. They were no windows. It wasn't a place for kids. So they figured out that actually, if they could build this minivan, this new type of car, new transport, and they called it a minivan, they built a category, right? And so then once people learn what the category is, there may be competitors, fast followers, whatever, but they were the inventors of that language. And so they built a market. They found a market, they engineered a market before they built the product. And so what I like to tell people is that you need to first engineer your market. You need to go out and you need to talk to a bunch of people, develop market IQ, fancy term for market research, which you can do way easier now with ChatGPT, and all these LLMs that are out there, Gemini, whatever. I don't want to promote anyone over another, and there's different use cases for those different things, but you can actually do a lot of market research without having to pay a market research team. But I encourage you to go out then and test those ideas against 100 different people of different ranks, of different roles, in different industries, to be able to gain a sense for, is there an opportunity to engineer a market here? Then we need to create a name for that market, that category. So we create the name for it, which is just a fancy way of saying, here's a business problem. So we're going to create a name for the business problem. business intelligence, enterprise resource planning, supply chain management, customer relationship management, enterprise AI. These are all business problems that we can recognize. And then what we have to do is we have to define what we mean, because people won't just necessarily grok it. We have to associate the attributes of the category. What must you be able to do if you're trying to sell into that market? And how do we know that? Well, because we interviewed a whole bunch of people and we got qualitative and quantitative scoring that tells us whether or not we can engineer this market. They may not call it what we're going to call it. They may have a bunch of definitive language that explains or describes the problem. Our job is to then create the term and then explain to them how this term solves that set of problems. So that's why I talk about market product fit, not around product market fit. And that's one of the major reasons why I think 85% of most startups fail, B2B, 96% of B2C fail. They fail because they don't do market product fit work very well. They fail to create a category, a differentiated category. They fail to create thought leadership, which ties them to the category. And then they fail to, if they do both those things, then they fail to recognize that they actually have to conscript other people into their category to have somebody to play against. So
And essentially to validate the market.
To validate the market.
All right, everyone, quick commercial break. If you're a MedTech CEO/founder, or maybe you're a sales or marketing leader at a startup or a scale-up, you're going to want to listen to this. Are you struggling to get in front of your ideal audience, whether that's investors or perhaps clinicians who want to adopt your product? Maybe you're getting ghosted. You send emails and messages and nothing comes back, nothing happens, right? Or worse, nobody knows who you are, right? In business, visibility is everything. And I always tell people, if you want to persuade before persuasion can happen, you have to learn how to get attention. So if your sales team is desperate for traction, clinicians don't know your name, investors have never heard of you, you're losing opportunities every day. And that needs to change now. Not tomorrow, not next week, now. That's where my company, Khateeb & Co. comes in. We don't just do marketing, we do growth. We figure out how to engineer markets by creating magnetic messaging that makes you impossible to ignore. And we build high impact strategies, of course, using social media, but other channels such as email, text, and others to help turn content and messaging into commercial pipeline, and it leads into closed deals. As an example, we worked with a surgical robotics company in raising a $31 million Series A, and then they needed help on their pre-market release. So we packed their CRM with 198 surgeon leads and nurtured them down. That ended up becoming 4 closed hospitals. 4 hospitals closed and adopted this technology within a period of 6 months, and they got 2 great key opinion leaders in the process. So whether you're a startup founder wearing too many hats, or maybe you have a marketing team that's just spread too thin and they don't have the expertise, my team and I plug in and partner up with your company, and we amplify your reach. From crafting powerful sales scripts to optimizing your team's demo calls, creating content, having it go out on a consistent basis, we transform your outreach into a growth engine. So if you're ready to dominate your market, you're ready to become a known name and people to know of you and take your calls and take your meetings, I want you to act right now. Don't wait anymore, because you've already wasted it plenty of time. Go to growmymedtech.com. That's growmymedtech.com. And I want you to schedule a quick call. My team and I will give you a free analysis with 2 to 3 actionable ideas. There's no strings attached. And if we're a fit, great. We can get partnered up and we can help you go to the next level. And if not, look, the ideas are always free. So do not wait and don't waste any more time. Go to growmymedtech.com right now, and let's make you the go-to name in your niche. Now, let's get back to the episode.
I want to bring up some of the infographics here just to talk to them. I think this is one of the issues where, while I love the fact that, like, compared to 10 years ago when I first discovered category design and everything through Play Bigger and also your book, it's way more common now. The problem is that I think a lot of novice category designers come up with like some term, and then I look at the company, I'm like, oh, this is the only company that kind of fits that, because it's like more, you know what I mean? And I'm like, well, that doesn't really help, right?
Yeah.
And I what I love is, it's the first time I've heard of it, is that this analogy of like building a stadium, it makes a lot of sense. And I think that some of the best, like, I'll give you a great example. I think the greatest quantitatively and qualitatively company in our industry is Intuitive. Intuitive is still technically, like, it's like barely a 3-product company. They're the biggest medical device company in the world now. They're bigger than Medtronic. They have $50 billion market cap, higher than Lockheed Martin, right? And they kind of did this around surgical robotics, right? Because there's a lot of, and I think this is why a lot of surgical robotic companies have failed competing against Intuitive, because they're essentially playing by their own words, own rule, by Intuitive's rules in their own game, and they're going to lose every single time.
Mm-hmm. No,
You
you're
know?
right. Yeah. The thing I have found, by the way, that it's great that you're bringing up the medical device industry up, obviously for obvious reasons. But my venture firm was half life sciences and half tech, and and in the life sciences we had medical devices was one of the investment categories. So there's always a two-phase problem with med devices, as you described. First, there's the FDA. Is it ethical? Does it work? Will it kill you? Right? I mean, those kinds of things. In med devices, we have a pathway to, this 501 pathway that we can get through, but that doesn't clear you through the market. Right, the next big hurdle, and this is why a lot of firms don't invest in MedTech, because they know it's a two-phase problem. Both can be expensive. So either through clinical trials, and then through after clinical trials, maybe into if they have to do a clinical trial. But no matter what, they've got to clear the market. They got to clear the commercial part of it, and it's very expensive to do that. And few do the work, which is rather shocking, because I think research is fundamental to science. So we do lots of product-based research, but we're not doing a lot of market-based research. And
I have a theory about that. I'll tell you my theory about this. There was a time in our industry where you can go and let's go, if we go back in time, 15, 20 years, what was the healthcare industry like? Well, you can come up with a really cool, shiny product that had incremental like improvement on the existing product. Walk into a hospital, show it to a surgeon. The surgeon's like, yeah, like, let me try it. And then for whatever reason, the surgeon decides to adopt it. Hospital pays for it. And you can just get by minimally. You don't even have to build a great company. And then some big player will say, yeah, look, like, we'll buy your thing for like 10, 20, 50, 100, $400 million, right? It was just like, that was the thing. Well, those days are past now. Nowadays, you actually have to build a great company, and building a great company means that, like, you have to, build an educated market. You have to do thought leadership. You have to do all these things. It's not enough just to have kind of a cool product with some IP and then you get FDA clearance. And I think that the industry as a whole is going through this growing pain where they're realizing that that's just like, it's table stakes now just to have a good product with FDA clearance, right? It's not enough. You have to build a true company. And so now a lot of leaders, in my opinion, who I have a lot of respect for, they're not used to thinking about, hey, like, how do we build an excellent marketing team and an excellent sales team? How do we do thought leadership in a unique way, right? And while I think like some of them do know about the technology adoption curve, they kind of talk about it just to kind of show that they know about it. They don't actually have the discipline to focus on it. And I'm going to bring, if you don't mind, I'm going to go to your infographic here so people can see it. For those who are watching, like, again, go to Spotify or YouTube, or actually I would recommend go follow Bruce over on LinkedIn, because he'll be posting a lot of this stuff. Let me have you kind of walk us through this chart here before we kind of compare, because you took the technology adoption curve and flattened it out, and I think that's a really, really important thing for people to see. But if you can walk us through this.
Sure. The idea was I wanted to create a taxonomy, something I didn't want a Michael Porter Harvard Business School marketing kind of a thing. I wanted something that within 5 to 10 minutes people could grok. And so this is what I came up with. Basically, we've got 3 phases that a company has to go, a startup has to go through. By the way, these phases exist for mature companies launching new products. So this isn't just for startups; it's also for mature companies thinking about introducing a new product to the market. So there's the go to product phase, the go to market phase, and the go to scale phase. And within there, I decided to adopt minimum viable product because a lot of people obviously have heard of this concept. And I always found that if you want to teach people something new, give them something they already understand, and then they're more accepting of it, and also it doesn't cause them to lose context, etc. What you don't want them doing is thinking about something else or trying to figure out what you're trying to tell them while you're trying to tell them something else. So
it can't be too new and novel, because then
exactly. So minimum viable product. Okay, great. Now I talk about the idea of market product fit. Other people talk about product market fit. But to me, MVP, it has a definition of the least amount of product that you can produce that someone will pay you for. That's the basic gist of it. I look at it slightly different, but that's fine. So I said, all right, but there's these different value inflection points that occur in a startup or product's history in their journey to scale that everybody has to go through. And I call them value inflection points because if you can reach them on the capital and revenue that you have, then you have demonstrated, that is, if you can reach the subsequent one on this continuum, like going from, let's say, idea to MVC, which is minimum viable category. If you can reach one of these value inflection points on the capital and cash that you have dramatically reduced risk in the company, and therefore to investors, you've dramatically increased the value of the company. So if you fail to reach the subsequent inflection point on this continuum, let's say you're at MVP and you're trying to get to minimum viable repeatability, and there's a whole definition for that. If you try to get to MVR, but you fail to reach that on the capital that you have and the revenue that you're generating, then interest in your company by investors is going to wane. It can wane dramatically, dependent upon where you were able to get. Now, in the SaaS industry, MVR, it's debatable, but it's somewhere around 4 to 6 million in ARR. So it turns out in revenue companies, that is just pure revenue, not subscription, it's not too different. It's not too dissimilar. If you're in a consumer company, it would be daily active usage rates and those types of things. So it's a different type of measurement. But these inflection points exist for any type of product and any type of model. When I wrote the book, I biased it for SaaS simply because that was what I was investing in. That's what. But these value inflection points work for MedTech. They work for everything, so there's just different metrics that we have to use. And when I do a new addition to the book, I will add some of those new metrics in. But you need to get to each one of these things, and it's important because minimum viable category helps us set up the stadium that we're going to play in, so that with initial product release, that's the beginning of the go-to-market phase, we have a way to describe what our product is, right? What category we're in, what problem we're solving. The initial product release is an important point. That's kind of what we would all call beta, right? We're testing it's more than just balsamic or some other kind of design tool. It actually exists in some form. And then minimum viable product. Okay, we have something people can use, and this is an important value inflection point for companies because this is the one thing you, as the software team or the technology team or the medical team, etc., you get to decide when MVP. When you're ready for MVP. And the reason I say this is because the venture capital clock starts ticking when you declare MVP. So you do not want to declare this until you got all your ducks in a row for marketing, sales, service, support, contracts. All these different things have to be well in place before you actively start to go to market. And start spending a lot of that capital that you have. So MVP is the one point in time that that you get the opportunity to say, okay, we're on the clock. You punch in with the investor community.
And I think, I'm happy you mentioned this because I think for our industry, between initial product release and MVP, I feel like that period might be when you have your FDA submission, you're waiting, but in that period, you can do what's called a limited market release, where you go and find like a few key customers to sell the product to at a lower price. Me personally, even if you guys are selling capital equipment, I don't believe in giving the product away for free. You want a little skin in the game. But I feel like during that time where you're waiting for FDA to come back, you have this limited market release between initial product release and MVP. That's where you start getting some feedback from people who see the vision, value the category, and are going to have like an honest conversation with the product team. So that way you can sort of tone this stuff up when you get to that MVP, because then the FDA does their clearance and now you're off to the races. And that's when people start hiring people, but they haven't done this work. And then they're shocked when a year in, they're like, oh, wow, we spent a lot of money and our revenue doesn't look so good.
Yeah, that's, that kind of goes to the point I was trying to make, which is that we have to be able to reach these successive value inflection points on the resources that we have in the company before we're going to be given more capital to then I mean, you can, but here are the consequences: down rounds, dilution, loss of employees, a lot of different bad things happen if you can't reach these things. And or even terms like participating preferred is thrown into the term sheet. So now you're having to give up multiples of your company before they participate pari passu in a subsequent financings.
And I think that's important for you to point out, because I think a lot of founders, I think there's too much celebration of raising money. And what people don't realize, like, when I see in my industry a company that's, I won't mention it, but there was a company recently that just raised $100 million and people are like, oh, wow, that's so impressive. I'm like, no, it's not. I'm like, because for them to make that money back, they're going to have to exit for a much higher number. And I don't see those kind of acquisitions happening every single day in our industry. If anything, a lot of our industry has become a lot more careful about these sort of transformative acquisitions that are $1 billion plus.
Yeah, that was one of the things that compelled me to write this book, because I felt there was a lot of behind the scene work that was happening that wasn't really told to employees, et cetera. And some of those came in the form of like subsequent rounds where the employees thought, hey, we're going public, but you're going public at a valuation less than what the last round was. That means that all of the equity that you thought that you had as an employee is worth zero. So
that happened to me. That happened to me at where I was like, oh, I have some shares in this company. And then I'm like, oh, great. Like, for me to even make a little bit of money, the share is going to have to be over $100. And oh yeah, the shares are under $1 today. So that's probably not going to happen.
Yeah. And I don't think employees are a lot smarter now. I mean, maybe 30 years ago, we didn't know that much about options and those things, but still companies don't share what the terms necessarily, what were the terms of the last round. And a lot of times those terms can be quite onerous, especially if the company missed one of these value inflection points and was now on the side of, instead of, being in the control of the round, they're at the mercy of the round. So that's why I pointed these out. That's why there's real metrics assigned to these. There's timing. So the distance, the amount of time between MVP and MVR is about somewhere around a year and a half to 2 years. The MVR to MVT, minimum viable traction, which is around 10 million. So 9 to 10 million of ARR. Again, these are terms. I wrote these metrics for SaaS just because that was what I was investing in.
I think it's transferable to MedTech, especially for a lot of the listeners. They do capital equipment. So for capital equipment, I mean, there's the capital equipment that's sold, but there are the consumables, right? Which is kind of like our version of like ARR.
Yeah. Yeah. So, and each industry has, each industry that we're participating in has its own, these own metrics. And again, I just expressed most of this stuff for these subscription businesses, but I'm probably going to do some other things like this new concept of services as software, which is in these new AI agentic systems that we can talk about later. But to finish up this this graphic, I wanted something that would be equivalent to a "You Are Here," directory. And what it let me do with my portfolio companies, and then with the clients that I work with, because each of these has a set of metrics associated with them, and I put them all into an infographic. You can either read the book, or you can just look at the infographic to see where these things are. It tells you where you are, and it tells you what isn't on here are 4 pillars: the product, revenue, team, and systems pillars. And each one of those, product, revenue, team, and system, each one of those things take a different point of prominence predicated upon where you are on this journey. So back in the go to product phase, the product pillar and team take prominence. You don't even need to worry about systems, really. You can run things on a spreadsheet. But as you move into things like getting ready for MVR you're going to need to worry about systems, because you're going to have to worry about being able to scale, and systems let us scale. So if I redo the graphic though, for the new edition of the book next year, I'm going to change it to being at a circle, and in the center of the circle will be team, and around the edges will be product, revenue, and systems. And the reason I'm going to do that is because team is the most important thing. It's the constant through this forever, in perpetuity. And the team needs to change dynamically, typically, dependent upon which one of these phases you're in. So, in the go to product phase, you don't need salespeople. Go to scale, we need salespeople. So, even if it's product led growth, so we need salespeople. So the net of it is, this is a prescriptive way. The book is a prescriptive guide to help you determine where are you, and you may need to even go back. Because there's a lot of steps that need to be done in order to move to the next successive value inflection point. And I talk about that in the book as well. I also created a team diagnostic that I let my portfolio companies and my clients take, where each member, CEO, CMO, the chief product officer, the head of engineering, everybody on the executive team takes this. It's a set of qualitative and quantitative questions. The question relates to each one of these phases, and it says, "Hey, did we do this?" And people answered yes, or I highly agree, I highly disagree, and then why. And that's the qualitative response. I generate a heat map out of all and it's amazing to see the divergence of opinions in the heat map between what the head of sales thinks and what the head of engineering thinks. So it's not always between them, but
I love that, and mainly because every successful founder, exec that I've met, they've always kind of gone back to like the importance of the team and people. But I think the other side of it is that we need better tools to qualitatively and quantitatively measure how much alignment do we have and where are we at. Because if there's one thing that's always in flux, is like the change of the company, and I think that a lot of times at least in our space, they don't do a sort of an assessment of that, and also even consider that somebody who might have been great in the early days of the company, maybe this new phase of the company, that person's actually the wrong person.
Yeah.
Bruce, as we kind of finish up the interview, and again, I really appreciate you coming on. The one thing I wanted to show was if you can just spend a few minutes on it and maybe give some of the founders some tips here, is I want to show, just as a reminder to the audience, this is the technology adoption curve. It's the bell-shaped curve. On the far left, we have the early adopters and innovators. You essentially took this and flattened it out into this graphic, which I absolutely love, in comparison to your traction gap. And I was wondering if you can kind of talk a little bit about, because again, this is the area that I think a lot of people skip over, they don't think about, which is after ideation, you have your minimally viable category. What are some of the questions, and what's something actionable that the founders listening can do to start thinking about and building that minimally viable category?
Yeah. Okay. So I'm going to the first is that the reason that the technology adoption lifecycle is a is represented by a curve is because the area under the curve represents market size. I took a different approach. It's not about market size, it's about time. And so those two things need to work together. So Jeffrey Moore, who wrote the book, Crossing the Chasm, was actually one of my partners at the venture firm. And so he's the reason I wrote the book, because he says, you got to take all this stuff and make it available. And a year later, I wanted to hit him, but because it is not easy to do this and to do it in a way that's meaningful. And I wanted to write something meaningful, not some pablum. So I asked Jeff. I said, "Hey, can I do something? Can we flatten your for you can represent things by standard deviation. If you look out there on the endpoints, that's like 2 standard deviations from the mean. Mine doesn't have anything to do with the market size. What mine has to do with is how long is it going to take for you to go from ideation to scale? Because in the investor community, interest is associated with scale, because you've proven something and it's valuable. So I said, let's tie the two together to show people where your concepts fit and mine. And Jeff is a much better writer than me, is way more of a philosopher than I am. And I was very appreciative that he was willing to allow me to bash it's not actually his curve. It's a guy who invented it in the 60s, but his chasm, which is associated with, he allowed me to take it, and then we laid them down side by side to kind of show timing. And I think this gives you a good idea about where they fit in. So, how do you use this? I think it becomes critically important from the standpoint of, once you identify where you believe you are, it gives you it tells you, well, who am I marketing to? Recognizing that on the left side of that chasm, you're marketing to people who are willing to take a lot of risk with their career. They're willing to take a lot of risk. So that would be like a physician who's willing to use your instrument. Somebody who likes to be on the bleeding edge of technology. Turns out, though, a lot of physicians, just like a lot of people, they're not willing to do that. They want to see 1,000 patients having gone through, whatever the mechanics are of your device or your product. And so those become the right side of the curve, the pragmatists, and we have to market to them differently. On the left side, we're marketing about well, I would put it this way, about our vision, our leadership, our skill sets. We want to market us as different, better, more advanced. And this is true of whether it's a software product or it's a medical device, or whether it's a CIO or it's a physician. So we have to talk in different terms. We have to use different language with that group. And so to get to the other side of the chasm, we have to have a lot of proof. We have to have lots of other people like ourselves. So, for example, if I don't want to just look at a DO's quote, I want to see an MD quote. That could be, or vice versa. I'm a DO. Maybe I want to see other DO. I want to see people like myself who have my type of training, my background, recommend this product. People I respect. So, and maybe I used the wrong trade-off or whatever, but that's, I wouldn't take a PA's, sole recommendation. I'd want to say, okay, that's great, it's fine, but who are the MDs that are using this? So the and it works that way in the software. It works that way in everything. So if it's a consumer product, if Sally wears this really great lipstick and really likes this really great, this great brand, and she says, hey, this is awesome, it's got great UV stuff in it, or whatever it is, it lasts forever, I'm going to try it. So it works the same way. But there's different ways that we have to reach these people. So it's critically important that you understand who in the heck you're selling to. Now, underneath it, what my thing is all about is, okay, well, how much time do we get, to win over those particular folks, to then move ourselves along into a different portion of the framework
a different point in a phase in the maturity of the company, because I'm most likely going to need additional capital to make the company work. Now, some companies it's revenue. That's great. And then you're not at the mercy of the investment community. But at some point, at some time, the people who are in your company, they're going to want to know, is there any liquidity in this thing? I'm not just working here to get paid, a paycheck. That's great. But I'm also here. I took this risk so I could also make some equity. Well, that equity is worth nothing as long as we're illiquid. So someone's going to want to buy us, or either the public markets have to want to buy us, or another company is going to want to buy us. When is that going to happen? Well, we have to get into that pragmatist and conservative phase, and we need to get through the go to product, go to market, and go to scale phase in order to reach those people. So that's why this is important. The how-to is in the book, or I have an advisory firm that this is what I do with my clients, is to work on this specific thing. I can do lots of other things. I've run my own company. I've done my other things, but I enjoy doing this because I think it will create the most amount of value at the most critical point in time of your company or your product. If you're in a larger company, I think this is where the value is created. The category. If you can achieve a market leadership position, the data shows that 76% of the profits of the category inure to the category leader. So that's why you want to do this.
As a humble disciple of your work, I completely agree. And what I'm hoping is that through this interview and some of your work, now that you're starting to proliferate more, it starts to get adopted more in our industry and implemented. Just because, at the end of the day, at least for my side, a lot of these products are really life-saving products. But if you don't build the company in the right way, they fail, and then as a result, like, patients end up suffering as a result. So Bruce, I want to thank you so much for coming on the show. I definitely want to have you back because there's still, I feel like there's so much we can cover, but I want to make sure that listeners can check this episode out. Meantime, aside from LinkedIn, where else can people find you?
So I have a draft of a website. It's marginally, I'll drop it into the chat when we're done here, and you can provide it to people who ask. I also have a white paper that I wrote about market engineering, what I do, and how I help companies, that I'll give to you as well, and you can propagate it to those who have interest. It's a pretty selective client list that I can take on. I don't take on things that I can't actually, if I can't put the time in, and but people come, they roll in and roll out. You're right. We get through these phases, and then other things are needed, and I don't do those other things. So this is a finite period of time. It's a 1 to 2 year engagement, at the discretion of the people I work with, of course. But that's about how long it takes to do this. So as people roll out, I have more room to take on more clients. But I'm happy to provide this to you, and then to your listeners. If you're interested, you can either get a hold of me through the contact information on the back of the white paper, or Omar can certainly connect you to me.
Absolutely. Well, awesome. Well, for the listeners who are checking this episode out, be sure to check the show notes. We'll leave the links there. As always, be sure to subscribe to the show. If you found value in this, whether you're an investor or founder, send this on to others to help them out. Give Bruce a follow on LinkedIn. Again, you'll thank me later. Turn on the notifications for his content. So for now, I'm your host, Omar Khateeb, and we'll see you all next time. Thanks for checking out this episode. If you want to do me a big favor and join so many other people who have helped grow this podcast, take a second and look below. If you're on Apple, give us 5 stars and write a short review. If you're on Spotify, just give us 5 stars. And if you're on YouTube, hit the like button. And most importantly, if you can, subscribe. We release so many different episodes that you may miss. Be sure to subscribe and turn your notifications on. You get extra points with me if you subscribe across all 3 channels. Thank you so much. And if you felt like this episode helped you, send this to somebody who'd really enjoy and appreciate it. Share and spread the love. We'll see you all next time.